This video is the second part, the part two of how to invest in foreign currencies through forex market. Is the second part of the first video I did, how to invest in foreign currencies and through the forex markets. So in the part one, I stopped at point 5, and point 5 was on fund your trading account, funding your trading account. And so once you are choosing a broker and you set up your account, you will need to deposit funds into your trading account. That's funding your account. So brokers typically accept various payment methods such as bank transfer, credit to debit cards, and e-wallet. Make sure to understand the minimum deposit requirements and any associated fees. You should be able to understand the minimum you can deposit and other related charges. Number 6, you use leverage wisely. When you deposit your money, you now use leverage. Use it wisely. Many forex brokers offers leverage, allowing you to control larger positions with smaller initial investments. For example, if you use a ratio of 10:1 leverage, you can trade $10,000 worth of currency with only $1,000 in your account. That's a ratio 10:1. While leverage can amplify your profits, don't forget it has associated risk, because it can also magnify your losses, your potential losses significantly. So use leverage cautiously. Don't go for a ratio 10:1. I think it's too big. Number 7, to make informed decisions, it's essential to stay updated on economic news and events that can impact currency prices. And so key market factors include interest rate, economic data, as well as geopolitical events. When it comes to interest rates, central bank interest rates decision can significantly affect currency values. So higher rates often strengthen a currency, while lower rates can weaken it. Then you have economic data. So report on GDP growth, unemployment, inflation, and trade balances, provide insight into a country's economic health. And not only that, it can influence, currency movements. The next item is geopolitical events. Political instability, trade wars, tariffs, and international conflict can cause volatility in currency markets. Number 8 is analyze the market. You need to carry out analysis, thorough analysis of the market, because that will enhance your rate of success. So successful forex trading relies on technical and fundamental analysis. When it comes to technical analysis, it involves analyzing historical price movements, chart patterns and technical indicators, example, moving averages, relative strengths index, to predict future price trends. So within the context of fundamental analysis, you focus on economic factors such as interest rates, inflation, and government policies that can affect currency values. So the analysis must involve both technical and fundamental. Number 9 is place your order. After you've used leverage cautiously, you've monitored the markets, you've analyzed the markets, you now want to place your order. So once you've chosen the currency pair and analyzed the market, you can place a trade through your broker's trading platform. You will need to decide either to buy or to sell. To trade size, you might incorporate stop loss and you may only decide to take profits. So let's look at buy or sell. If you expect the base currency to appreciate, you buy the pair as you go long. If you expect, the base currency to depreciate, in that case, you will sell the pair. You go short. You could adopt both, long and short, positions. So you also incorporate what is called trade size. Determine how much of the currency pair you want to trade. Most brokers allow trading in standards of lots. You have 100,000 units of the base currency and mini lots, 10,000 units of the base currency, or micro lots, 1,000 units of the base currency. So you need to make use of stop loss and trap, and then you may need to stop loss and take profits. To set up a stop loss order to limit potential losses and take profit orders to lock in profits when your target price is reached. You can set a stop loss order. That means that if you set a stop loss order, once the price gets to that level, it can't go below that level. The system will automatically sell off the stocks. You also sell off the currency pair so as not to incur losses. Then number 10 is risk management. Forex is inherently risky. You must have a solid risk management model in place. So forex trading involves significant risk, and so it's important to have a risk management plan. Number one here is diversification. You diversify. So avoid putting all your funds into one currency pair. Diversify US dollar, USD stroke euro, USD stroke maybe Japanese yen, the British pounds, versus euro, stroke euro, all those pairs, different pairs as well. Number 3 is use stop losses. Set stop loss orders to automatically close a trade if the market moves against you, so as to limit your potential losses. And then you consider position size. So only risk a small percentage of your capital to each trade to prevent large losses. Don't put too much of your capital in a single trade, so you tend to reduce your position sizes so as to be able to avoid large losses.